Hey, and welcome to my channel Fiscal Voyage. I'm Felix, and today we're going to talk about Carnival Corporation and in a 5-minute stock analysis, and we're going to determine if it's a buy, hold, or sell. Coming right up.
Okay, so here's the 5-minute stock analysis on Carnival Corporation. Could be found in the New York Stock Exchange as CCL. Carnival Cruise Line was founded in 1972, and Carnival is the largest cruise line in the world based on passenger carried annually revenue, and total numbers of ships in fleet. Carnival is one of the 10 cruise line brands owned by the world's largest cruise ship operator, the American British Carnival Corporation. And in 2018, Carnival Cruise Line was estimated to hold an 8.9% share of cruise industry revenue and 22.0% of passengers. It has 26 vessels and is the largest fleet in the Carnival Group. And from 2009 to 2018, revenue grew at a compound rate of 4.09%. Net income grew at a rate of 6.49% at that same time frame, and they currently have a S&P credit rating of A minus. Uh, Year to date, operating income grew at 14.73%, and the earning per share growth year to date is 23.68%, which is excellent. The net income 5-year average is 23.93%, and the earnings per share growth of 26.5% in the 5-year average. So basically, they've been growing at a great rate with operating and net income as well as earnings. For 2018, they had adjusted earnings per share of $4.26. Net margin came in at 16.69 in 2018 versus 14.88% for 2017. So their earning net margin has been expanding. Debt to cap as 25%, which is pretty low. And the current dividend is at 3.9%, which is a nice dividend yield, very attractive dividend yield. This is kind of where I like to see companies at with a 4% dividend yield. And they have a nice dividend payout ratio of 49%. So right there in the halfway mark. And they've been only growing dividends for 4 years. So that's something that I'm not really fond of. I like companies with 7, 10 years, 15 years, 20 years, and plus years of dividend growth. So 4 years is pretty low. They actually have been growing at a very irregular rate. For example, they'll grow it every 2 quarter or 5 quarters, so it's not regular. So that's something to consider. And the 5-year dividend growth rate average is 14.29%, which is great. They have a Chowder rule of 18.17, which is basically dividend yield plus the 5-year dividend growth, which is 18. So anything above 12 is really good. And the most dividend increase was 11.1%. All right, so future outlook for this year, they're expecting analysts are expecting $4.55 in earnings, and 2020 $5.06 versus last year's $4.26. So this is projected to grow earnings higher than previous years. The 3-year projected earnings compound annual growth rate is at 3% from CFRA. Currently, they have a forward PE of 10.22 versus a 5-year average of 19.48, and the current PE is at 11.36. So it's definitely undervalued based on PE. Right here we have a fast graphs. The black line represents monthly closing price, and the blue line is the normal PE, and the yellow, rather orange, is the earnings. So as you can see, normally price follows earnings, and we have here a PE average of 18 for the past 10 years. And currently we had 11% PE, 11 PE. So it's basically undervalued based on that. We have here is the fair value price. So CFRA gives us $71.60. Simply Wally at $67.15. Fast Graphs estimate at $78. Yahoo at $62. And my dividend discount model at $73.30. So we average out those five fair value price, and we get a fair value price of $70.56. And currently, you get Carnival Corporation priced at $51.61. So basically means it's 36% undervalued. So with that, I give it a buy recommendation. The only thing I don't like about this company is the 4-year dividend growth rate and the irregular of the dividend growth as well. Besides that, I think this is a great long-term company because people love to travel with cruise lines. It's so easy to travel. There's a floating hotel, like a lot of people say. The only problem with this industry is prone to the recession. But even if a recession were to hit, I personally would just be buying more shares because it's a long-term business, and like I said, people love cruise lines. So with that, I recommend it a buy. And thank you for watching, and make sure to check out my website fiscalvoice.com, and as well as the portfolio, which is linked in the description. And make sure to like the video and subscribe if you want to see more, and comment below what other companies would you like me to see to analyze. So thanks again for watching.